Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into one of Singapore's most iconic stocks, Singapore Airlines. SIA just reported a set of numbers that, at first glance, look like a dream come true for investors. But here's the twist. Even with a record net profit and a healthy dividend, analysts are now putting a reduced rating on the stock. Why would they do that? What are the hidden risks and opportunities? And what does this mean for your portfolio, especially if you're investing through your CPF or SRS? Let's break it all down, and as always, I'll share my own take and what I think most analysts might be missing. Let's start with the headline numbers. For the financial year ending March 2025, Singapore Airlines posted a net profit of about 2.8 billion Singapore dollars. That's a massive number, but it's important to know where it came from. About $1.1 billion of that profit is actually a non-cash accounting gain from the merger between Air India and Vistara, where SIA holds a significant stake. If we strip out that one-off gain, the core profit after tax and minority interests, what analysts call PTMI, comes in at $1.67 billion. That's down nearly 33% from last year. So while the headline profit looks great, the underlying business actually saw a notable drop in profitability. Now, why did profits fall? The answer is competition and pricing pressure. SIA and its budget arm, Scoot, carried 8.1% more passengers than last year. That's a solid growth number, but it didn't translate into higher profits. The passenger load factor, which measures how full the planes are, actually slipped by 1.4 percentage points to 86.6%. That's still healthy, but it shows that SIA is having a harder time filling seats as it adds more capacity. More worrying is the drop in passenger yields, which fell by 5.5% to 10.3 cents per passenger kilometer. In plain English, SIA is earning less revenue for every seat it sells, mainly because competition is heating up across Asia. Chinese carriers in particular have ramped up flights to Southeast Asia, putting pressure on ticket prices. Let's talk about dividends, because that's what many Singaporean investors care about most. SIA declared a total dividend of 40 cents per share for the year. That's a big jump from the 38 cents paid last year and represents a payout ratio of 46% of reported earnings. If you adjust for the non-recurring gains, the payout ratio rises to about 71%. That sounds attractive, especially if you're comparing it to the 2.5% you get from CPF ordinary account savings. But here's the thing. Analysts are now expecting next year's dividend to drop to 30 cents per share. Why? Because SIA's management is signaling caution. They're sitting on a massive net cash position of $8.3 billion, but they're also facing delayed aircraft deliveries and uncertain market conditions. They want to keep some dry powder in case things get rough. Now, if you're thinking about buying SIA shares with your CPF or SRS funds, there are a few things you need to know. For CPF investors, you can only use up to 35% of your investable savings to buy stocks, and SIA is on the CPFIS approved list. The current dividend yield, based on the 40-cent payout and a share price around $6, is roughly 6.7%. That's much higher than CPF's 2.5%, but remember, dividends from CPF investments get credited back into your CPF account, not your pocket. For SRS investors, the story's a bit different. SRS funds are meant for retirement, and dividend income is tax-free as long as it stays in the account. SIA's relatively stable dividends could be a good fit for a conservative SRS portfolio, but the analyst downgrade suggests you should temper your expectations for capital gains. So why did the analysts downgrade SIA from neutral to reduce, even as they raised the target price from 5.73 to $6.08? It all comes down to valuation and future risks. SIA is now trading at about 1.1 times its book value, which is a premium compared to its historical average. The recent run-up in share price has priced in a lot of good news, from strong forward bookings to lower jet fuel prices and a weaker US dollar, which helps reduce costs. But there are risks on the horizon. Cargo revenue, which was a big profit driver during the pandemic, is starting to soften as global trade slows and US-China tensions persist. There's also the risk that competition will keep yields under pressure, making it harder for SIA to grow profits without cutting costs or finding new revenue streams. Let's zoom out and look at the bigger picture. Singapore Airlines is not just a local champion. It's a key player in the global aviation industry. The airline's 25.1% stake in the merged Air India Vistara entity is a long-term play on India's fast-growing travel market. India is set to become the world's third-largest aviation market by 2026, and SIA's partnership gives it a foothold in that growth. But there are execution risks. Air India has struggled with profitability and service standards, and the integration with Vistara won't be easy. If SIA can help turn things around, it could unlock new transit traffic between North America, Europe, and Asia via Indian hubs. But that's a big if, and it will take years to play out. For Singaporean investors, there are also local policy factors to consider. The government's Air Transport Industry Transformation Map 2025 aims to strengthen Singapore's position as a global aviation hub. This includes investments in Changi Airport's expansion, digital innovation, and workforce upskilling. SIA stands to benefit from these initiatives, but it also faces higher operating costs and expectations to maintain service excellence. If you're investing through CPF or SRS, these long-term trends matter just as much as next year's dividend. Let's not forget about macroeconomic headwinds. Global travel demand has rebounded strongly since borders reopened, but there are signs of moderation. The International Air Transport Association, or IATA, expects global passenger numbers to hit 4.7 billion in 2025, surpassing pre-pandemic levels. But growth is slowing, and airlines are facing higher costs for labor, maintenance, and airport fees. Jet fuel prices have come down from their 2022 peaks, but they remain volatile and sensitive to geopolitical shocks. Any spike in oil prices or a sudden drop in demand could hit SCA's margins hard. So, what's my take on all this? I think the analyst downgrade is justified, but maybe a bit too cautious. SIA is in a much stronger financial position than it was before the pandemic. Its net cash pile gives it flexibility to weather short-term turbulence and invest in future growth. The airline's brand and service quality remain top-notch, and its partnerships in India and with other Star Alliance members offer long-term upside. But at current valuations, the market is already pricing in a lot of good news. If you're a long-term investor, it might make sense to hold on to your shares and collect the dividends, but I wouldn't be rushing to buy more at these levels. For dividend hunters, it's important to set realistic expectations. The 40-cent dividend for FY 2025 is generous, but it's unlikely to be repeated next year. Management is signaling a more conservative approach, and analysts expect the payout to drop to 30 cents. That would bring the yield down to about 5%, still attractive, but not exceptional given the risks. If you're relying on SIA for steady income, make sure your portfolio is diversified and not overly exposed to the airline sector. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Our members get access to daily updates, model portfolios, and special reports on CPF and SRS strategies, all designed to help you make smarter decisions. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. Before we wrap up, let's talk about the key risks and opportunities that most people overlook. On the risk side, SEA is exposed to global shocks. Think pandemics, oil price spikes, or geopolitical tensions. The airline's cargo business, which was a lifesaver during COVID, is now facing headwinds as global trade slows. Any escalation in US-China trade tensions could hurt both passenger and cargo demand. On the opportunity side, SIA's strong balance sheet and government backing give it a safety net that many competitors lack. The airline is also investing in digital transformation, from contactless check-ins to data-driven pricing, which could unlock new efficiencies and revenue streams. So, What's the bottom line for Singaporean investors? If you're a short-term trader, the reduced rating is a clear signal to be cautious. The share price has run up, and any disappointment in earnings or dividends could trigger a pullback. For long-term investors, SIA remains a solid blue-chip holding, but don't expect fireworks. The best days of post-pandemic recovery are likely behind us, and the airline will need to work harder to grow profits in a more competitive market. As always, do your own research, stay diversified, and invest wisely. Thanks for watching, and if you enjoyed this deep dive, don't forget to like, subscribe, and check out our premium membership for even more exclusive content. I'm Iggy, and I'll see you in the next video.